In a moment, I will bring on JD White and Cameron Dye to show you how they have helped hundreds of families manage their retirement tax bill by working proactively to shift funds into a tax-free bucket. Both JD and Cameron are certified financial planners with a combined experience of close to 20 years in the industry. They are both former athletes at a high level and pride themselves on being the best they can for their clients. I'm showing you our disclosures for this webinar. The information discussed today contains a lot of discussions around taxes. We are not tax preparers, and this is not intended to be a substitute for specific individualized tax advice. We do suggest that you discuss your specific tax questions with qualified tax advisors. We will have some time at the end of this webinar for Q&As. Please use the chat box at the bottom of this window, and we will get to whatever we can at the end of our presentation. We have asked that you provide some questions during registration, which we will also cover during that time if it was not already addressed. Now, without further ado, please welcome Whitehouse Wealth Management's very own JD White and Cameron Dye.
Hello, everyone, and welcome to our first webinar of 2024. Thank you, Jennifer, for the great introduction. Looking forward to showing you, all of you, how we have helped hundreds of families move towards a tax-free retirement. Full disclosure here, it is nearly impossible to create a 100% tax-free retirement. We plan to show you several strategies that we've used to help manage tax bills for our clients and how you can use them. And we'll discuss some of the limiting rules and regulations that we are navigating currently with our clients. So the first thing that we need to talk about is, at the highest level, the different types of tax buckets that we have. So the first bucket that that most of us put most of our money into is the pre-tax bucket. The pre-tax bucket is your, for most people, 401k, rollover IRAs. Money goes in, the taxes get deferred out, and we get taxed on it when we pull it out. The middle bucket is our most neglected bucket. The taxable bucket pretty much holds everything outside of retirement accounts. That's your savings accounts, brokerage accounts, real estate, anything like that. The way that works, that money goes in after tax. Grows, we pay some of the taxes as it grows, and then when we pull it out, we typically will pay either long-term capital gains, or we'll have long-term capital losses or short-term on those. And then we have the tax-free bucket, which is taxed after tax when it goes in, so we've already paid the taxes, and then when we pull it out, it comes out tax-free, which we really like. So Cameron, going to kick it over to Cameron. He's going to tell us why he likes the tax-free bucket so much.
Sure. Well, I think you hit on the first piece, that it is tax-free, which although it's not tax-free totally because the money was pre-tax going in, it is tax-free coming out, which we definitely like. The bulk of the reasons that we like the tax-free bucket are philosophical. We'll be able to show you the numbers, why it's advantageous from a tax perspective. But the biggest reason is that the idea that things inevitably change over time. And at some point, having tax-free funds is going to be really advantageous for people. The two top bullet points here kind of go over the things we think the most about when it comes to differentiating between the pre-tax bucket and the tax-free bucket. Withdrawals from the tax-free bucket do not create shadow taxes. And what we mean by shadow taxes is the taxes that you paid on the growth of the money that went into a tax-deferred bucket. So, for example, you put money into your 401k, that money's pre-tax, you know you're going to pay tax on that later. The thing people don't always think about is you're also going to pay taxes on the growth of that money later. And we'll show you some numbers later to go over that. But the other piece is the required minimum distribution. At some point, you are either going to need to take out money to live by, or you are going to be required to take money out of the pre-tax bucket. Currently, that age is 73. That's slated to go to 75 here, I think, in about 8 years. But at some point, you're going to be forced to take it out. And you will almost inevitably, in retirement, at some point, have an event where you need money. And having that money in a tax-free bucket allows you to take that money out and not worry about the income taxes. Just take it out, use it the way you need it, long-term care events are a lot of times the event of the day. And so having that ability to just spend the money, know exactly how much you have, not factored into your income tax, that's the biggest reason why we like it. I'll kick it back to JD to talk about some of the specific rules involved.
Yeah, so good points. And from an estate planning piece, you know, when the Secure Act 2.0 rolled out, they made it so that if you're a non-spouse beneficiary, basically under that umbrella, you now have to take the entire IRA out of the account within a 10-year period. And they're not making everybody take the money out right now. So it's kind of on you to take that money out. And if it's in a pre-tax bucket, you're now getting taxed on those withdrawals. So we're creating something that's taxable to our heirs if we're not transitioning these funds. So in the tax-free bucket, they're still going to make you pull those funds out, but no taxes owed. So we really like that piece. The other piece, and it's on the next slide, is that the IRS cannot actually collect on the growth of those funds in the tax-free bucket. So it's just some high level numbers here. If we have an account that starts at $100,000 and you're in the 24% federal tax bracket, you would owe 24 grand on that. Just simple math. You pull out 100 grand, you're going to pay 24,000 on that. If we do a great job, we grow it at 8.5% for 10 years. The value is now at 226 grand plus a little bit. You're still in the 24% tax bracket. Now the IRS is going to collect 54 grand. So the IRS is actually getting paid over $30,000 for us and you growing your account. They're getting a benefit from that pre-tax bucket growing. So not something that we really like. If we can pay them now and then keep all that growth, which we'll talk about, that's pretty key for us.
Yeah. So, I mean, going off of that point, JD, that paying the taxes that you know is ideal when you can. If you pay the taxes before money goes into a pre-tax bucket, you know exactly the amount you paid on it. Because the one thing we don't know for sure is what taxes are going to do in the future. I think we would be hard pressed to think they're going to come down much. And as you can see here on this next slide, the taxes are actually slated to go up in 2026 because of the act that was passed a few years ago. They are looking to go up between 2.5% and 3%, pretty much across the board. So unless Congress changes that, this is what is scheduled to happen here in another 2 years. Not everybody's in a place to do a conversion or move money into a tax-free bucket now, but there is some thought that taxes are likely to go up, if not stay where they are. So that's one thing. Now we'll go over the major ways to get into the tax-free bucket. So some of them are fairly simple, some of them are fairly complex, some of them even revolve around extra IRS forms, which we'll touch on later. But we'll start with the simplest idea. The simplest is just a straight contribution. So think of a Roth IRA. If you are under 50, you can put $7,000 in there this year. If you are over 50, you get an extra $1,000 catch-up, so you can put $8,000 in there. And it just goes straight into a Roth IRA. That's the simplest version. The other caveat to being able to make contributions directly to a Roth IRA in this example would be your income. So if you are a joint household, filing jointly, and you make over $230,000, you're actually ineligible to make a contribution to a Roth IRA. The workaround for that is what we call a backdoor Roth contribution. You take after-tax dollars, so similar to what you would put into a Roth, put them into a traditional IRA. So the actual amounts you can put in are the same, $7,000 or $8,000. And then we immediately move it into the tax-free bucket. It's a little more complex. It involves us doing some more work. There is an IRS form that has to be filed to make sure that the CPA and the government know that it was after-tax money. So you weren't trying to defer it now. But that's a way to work around sort of the income limit. And then the third way I want to hit on is conversions, which we'll talk way more in depth down later in the talk. But taking money that was previously put into the pre-tax bucket. So think your 401k, those paychecks every 2 weeks, money goes in the 401k, sits there for 30 years. And then you want to convert that into the tax-free bucket. And the way you do that is by simply taking the money that you want to convert paying the taxes either from the account or from a separate place, and then moving the money into that tax-free bucket. And from that point on, it's after-tax money in a tax-free bucket, so it will grow tax-free. And that's going to be something we'll touch on later. But those are the three, I guess, most common ways. JD, why don't you hit on the newest way to really take advantage of the Roth?
Yeah, that's right. And if you're sweating on these, like, this is a pretty simple chart. We're going to dive into these here momentarily, so don't worry. We're going to talk about kind of the logistics of processing all this stuff. The last one, which is a fairly new thing that has passed, all the regulations, is the employer match. So for a while now, we've had the ability to contribute to Roth K in a lot of employer plans through work. Now we're actually, most plans are allowing us to request that our employer does the match, whether that's the non-elective or the profit sharing match, as Roth. So they get the deduction still for putting that money in, but it's after-tax dollars, so you don't get the deduction for it. But kind of a newer little piece that has come out recently. A lot of plans employers don't even know that it's an option. We're asking all of our clients to make sure that they're talking to their employers about it if we're trying to fill up that tax-free bucket. So next, we're going to kind of lay out a scenario for Bob and Jane Smith, not real clients, but real situation, where really the numbers do make sense to do Roth conversion. And we think you're going to like kind of the numbers at the end of this. So I'm just going to kind of lay out the high level here. Bob and Jane are the exact same age, 55 years old, expected to live to 85. We kept this all these are pretty straightforward math for us. Plan to retire in 10 years at 65. Current income for this year be $225,000. They're in Colorado, so they'll fall into the 24% federal bracket. We have a 4.4% tax here. We'll talk about state taxes briefly. We're going to assume that we're getting 6% growth, so nothing crazy there. And then we're going to take their accounts to zero. So when they both die at 85, accounts are at $0. We're going to convert all of the money and withhold the taxes on those conversions, which is not ideal. We'll hit on that too. But we're going to take the conversions and actually pull the taxes out of that money as we convert it. And then we're going to assume that the tax rates don't change, even though we just showed you that they're scheduled to change. We're going to assume they don't, and that they have $600,000 combined for them in traditional IRAs. All right, so Cam, can you kind of explain kind of the high level assumptions here on this next page, and what you see for Bob and Jane?
Yeah. So, I mean, again, this is a very simplistic, it's real life, but it's simple because the numbers are not going to change. So because they're in the 24% tax bracket, that bracket goes all the way up to $383,000. So that means that from their income at 225 up to the top of the bracket, there's 158,900 that they can add on as conversion that will get added to their income, but keep them in the same tax bracket. And that is important because we want to not impose extra taxes on people while doing these conversions when we can. So for them, that's the number that we're going to convert every year. We're going to keep that stationary. We're just going to convert $158,000 every year for 4 years. That'll dwindle down most of the account. As JD said, we're going to keep the steady growth at 6%, bring the balance of that IRA to zero by converting all of the assets, which means in that 5th year, if you actually crunch the numbers, they're only going to convert 77,000 because that's all that's left. And then JD touched on, and we'll go through this a little more later, but in this example, it's not ideal, but most times this is the way it works, where we let the account pay for itself, where the money that's in that tax deferred bucket, as we convert it, we take out the taxes, we withhold them just like you would a distribution, and move over whatever percentage is left. So it is a smaller amount getting moved over after taxes. We'll go through later why that's not ideal, but in this case, that's how we broke it down. It makes the math a lot easier. JD, why don't you go over the numbers here? Yeah.
So on this next slide here, you're going to kind of see the nerdy side of what we do. So on the left-hand side of this table here, we've got what happens to their assets without doing any conversions. And then the right side, we've got what happens when we converted the entire IRA balance over to Roth over that period of 5 years. So really the biggest thing here, we're going to do the maximum withdrawal. So again, the goal is to take the balance to $0. So it's a time value calculation where we're just running it to zero. The maximum withdrawal we can take each year is a steady 93K plus. The taxes on those withdrawals, again, we're paying about 30% on that. It's about 26 grand, which brings the net payment that they would be able to take home about 67 grand every year after taxes. So in scenario one, we will have paid $532,000. We're doing that over the lifetime. So over 30 years, we're paying those taxes. And again, the IRS is collecting on the growth that we're doing along the way. In scenario two, we converted all those assets. So we essentially paid all the taxes over a 5-year period. We're going to do the same net withdrawal. So we're going to take the same $67,000 after tax, but we're not going to pay any taxes on those withdrawals. So even though the balance is a little bit lower when we start, we're not getting taxed on any of those withdrawals. And we actually end with a balance of $185,000 that would get passed to their beneficiaries, assuming they have any, totally tax-free. So their kids are going to be able to pull those funds out, not pay any taxes on it. And you'll notice the bottom line here, total taxes paid, which were paid in those first 5 years, is $200,000+. A difference in over $330,000 that we're not paying the IRS over that lifetime is huge. Plus we have 185 grand left over in that second scenario. So really, really huge numbers there for us, assuming the numbers don't change. Again, we know that taxes will likely go up in 2026. There's also a little bit of a bonus strategy for us that we're looking to implement. If our client's portfolio drops, say 15-20%, why not convert a little extra, knowing that we're getting a discount on what we're paying the IRS? So if the account value drops from 100 to 85 grand and we convert that, we're paying the IRS a little bit less money. And we know that the likelihood of that account value coming back from a simple correction or downturn is pretty high. So little gravy on top there for you. Something that we're looking to do. These are not easy things, but they're very doable. All right. So next piece here, we want to talk, Cam, we're going to go the other direction, right? With
yeah. So sure. I mean, those numbers are pretty impressive. It's actually amazing that you can save $330,000 in lifetime taxes by implementing a fairly straightforward strategy if you keep track of it. But it's not always the case that it makes sense. There are cases, we're going to run through one right now, where for Steve and Sally, at least while they're working, it probably doesn't make sense to start converting. Now, that's not to say it won't make sense when they retire, but at least when they're starting out, looking at this, similar, they're call it 55 years old, but they're in the 35% tax bracket. So when you add on their federal and state income tax, they're looking at almost 40% in taxes on every dollar that gets converted. That's a pretty hefty sum. Even if we continue to grow it at 6%, take the accounts to zero, we're going to assume that tax rates don't change again. We know they will, but in this example, they don't. And they have $500,000 in their traditional IRA. So just by knowing they're in the 35% bracket, you know they're making very high incomes and they're paying a lot of taxes. So if we go to this next slide here, you can see what happens when we actually look to try and do a conversion. If you wanted to convert $65,000, you'd be looking at $22,000 in federal taxes. You'd be looking at $2,800 in state taxes, for a total of $25,000 for the ability to convert less than $40,000. So as you can see, the percentages of what gets paid to taxes versus what actually gets converted over into that tax-free bucket is getting closer. Like it's getting much closer. And because of that, it doesn't make sense at this time for Sally and Steve to convert because the income bracket is too high and the amount of taxes they'll pay, especially if they're doing large sums. Now, something is better than nothing. They could take, $10,000 or $15,000 each year and start moving it over. But the biggest thing to keep in mind for a couple like this would be that in retirement, typically people fall 1 to 2 tax brackets. So while they're in the 35% federal bracket right now, when they retire in 10 or 15 years, they're likely going to move down to the 24 or 22% tax bracket. And even if tax rates on the whole have gone up, they're still going to be coming down brackets. So they are more likely going to start their process of conversion after they retire, because the math will look more similar to the previous example. But this is an example of why the conversions, while in theory are always a good idea, the timing of it may not always make sense during your employment years. And another thing to think about would be, in this case, say Steve worked half a year, took a sabbatical, unpaid. So his income came way down in a certain year, or if he got laid off, or if, Sally retires early. And so if they bring the income down through other ways, then that will bring their tax bracket down. And then we would relook at converting at that point, because it might make a lot more sense.
Yeah, I mean, you're right on there. This is all so super fluid. As things change, we want to jump on opportunities, even though those are bad situations. Potentially, there are situations where we can benefit on the tax side. So that's why we try and be involved with our clients' lives, so we can kind of keep up with what's going on, because there's opportunities for us outside of investments on the tax front where we can have a huge impact. And at the end of the day, I think that Cam and I are on the same page. Something is better than nothing. Maybe we talk to Steve and Sally, and maybe we just convert a little bit. We talk to their CPA. Maybe we just convert 5-10 grand. We just do a little bit here, a little bit there. We find other ways to fill up that tax-free bucket, because something is better than nothing. It gives us flexibility for when things happen that are out of our control, to have to not pay the IRS as part of that situation. One little last piece there. If you currently live in a state with a zero tax rate, or a lower tax rate than where you might move in the future, what a great opportunity, right? Because if you're in a tax-free state like Texas, I know someone is on here that's from Texas, and you maybe down the road move to another state where there's a tax, and you're pulling money out of these IRAs, you just added an extra bill to that. So why not convert some of that now, pay a 0% state tax? Or if it's the other way around too, if we know you're moving to a state-free tax, maybe we hold off on that and wait till you move to the state with zero tax and convert then. So very fluid stuff. All right, so we're going to jump into the next piece, which is the art of the backdoor Roth IRA. This thing gets a lot of traction in headlines, especially in our world. Like we read this stuff a lot. At the end of the day, it's not beneficial for most people that we work with, but it's a great strategy. And so we'll walk through kind of how this happens. So Cam kind of hit on this a little bit. What we're doing is we're taking after-tax money, so money that is in our checking account, we've already paid taxes on it, and we're funneling it through a traditional IRA and then converting it into the tax-free bucket. And the way this works, if we don't have IRA assets, this is pretty clean. We don't pay any taxes on any of this. The limits Cam already hit on, and there is some paperwork that's involved. So on the next slide, we'll show some of the math here. This is where it gets a little bit sticky. So if you have IRAs, doesn't matter where they're at, doesn't matter if you have them at 100 different places. You could have one at LPL, one at Charles Schwab, it doesn't matter. They all get combined into a value. And so if you have those, the math looks like this. So in this first scenario up here, we're trying to backdoor Roth $7,000 through the funnel into the Roth IRA. However, these clients have $593,000 in other IRAs. This is each person, I believe. The math on this is that we multiply the 593, and we made that a round number for a reason. So the 593 times the $7,000 contribution, then divide it by the total. And that tells us how much of that $7,000 contribution we actually have to pay taxes on as a conversion. So what the IRS is doing is they're saying, well, when you put that money in, we're not going to separate that out. It's all part of the same pot. And so what you're converting is partly after-tax money, and then mostly pre-tax money. So you're going to owe taxes on that. And so in this scenario, we're basically just doing a conversion where we're paying taxes on it. Doesn't make sense. Over $6,900, over 99% of this backdoor Roth contribution is a taxable conversion. So it doesn't make sense. In this scenario, we wouldn't do it. We would just say, well, let's just look at doing conversions. We're going to skip that middle step of funneling it through the thing. In this second scenario, even with a really small IRA balance, so just $3,000 in existing IRA balance, the taxable portion still ends up being 30%. So even with a really small piece, you still end up owing taxes on a good chunk of the conversion. So you almost have to have zero IRA assets for the backdoor Roth IRA to make any sense.
Yeah, so the other, I guess, more complicated one that we've been talking about is conversions. So to do a conversion, again, you're taking money that's already been in a pre-tax bucket and you're moving it to an after-tax bucket. Because it was in a pre-tax bucket, you have three choices. You can either pay the taxes now by converting the assets, pay it later in life when you're either forced to take it out through a distribution or you want to take it out through a distribution, or you pass away and your beneficiaries get to pay the taxes, as JD went over with the 10-year rule if they're not a spouse. It's a fairly complicated idea at that point because, as we know, there's two things that are certain in life: taxes and death. And at some point, they're both going to happen. So the government's going to get its money. The options for paying the taxes out of the pre-tax bucket. So you have two choices. We've kind of touched on both of them, but if you were to convert assets, you have to add the amount you are converting to your income. And then you can either, as the first example we used with Bob and Jane, I think, we took money from the account, similar to a distribution, withheld it for taxes and converted a smaller amount. That's probably the most common way. But we also mentioned that wasn't an ideal situation. The perfect scenario is we take money and convert it, and we convert the whole amount. So just simple math, simple examples, move $100,000 from your pre-tax bucket into your tax-free bucket. If you're in that 24.5% tax bracket, you're going to owe $29,000 in taxes. So instead of saying we have 100,000, we're going to take out 29 and convert 71,000. We take that entire 100,000 and convert the whole thing. Well, you still have to pay the taxes. But in a perfect scenario, you can take that money from either an investment account, a checking account, a savings account, some other pool of money, and send the IRS a check for $29,000 to cover the tax bill, while allowing the assets as a whole to stay together and continue to grow from that higher amount. So that's the perfect scenario. And part of the reason we want to do that is because, as we've talked about with the shadow tax idea, if you take $100,000 and in a year you make 10%, that's great. You made $10,000. But if you leave that in the pre-tax bucket, at some point in the future, someone is going to have to pay the taxes on that 10% growth. So just as you can see, it's the same numbers. If the account goes up 10%, but you're going to owe 24.5% in taxes, your account actually only went up 7.1%. Still a good return, but again, you're paying the government the extra tax on the growth that your account earned. So you're basically tipping the IRS, if you will, which if we can avoid it, we will. The key thing to remember is we never, ever want anybody to be in any sort of a hardship or feel super stressed about a conversion because they want to do it, but they want to try and do it this perfect way. The money can always come out of the account. The account can pay for itself during the conversion. But these are sort of the two major ways that we run through how to get that money converted and then how to pay the taxes on it.
Yeah. At the end of the day, we're beating the same drum here. Something is better than nothing. If we can convert and get money into that tax-free bucket, great. Let's figure out a way to do it. Let's make sure our clients are happy. This is really simple stuff, right? No, I'm just kidding. These are very complex things that we're talking through here. And honestly, the idea of the IRS, like whittling down the hard work that we're doing in the accounts for our clients, it's kind of, it kind of sucks, but it is what it is. So, why not consider this stuff? We just try and have a team in place to execute on these things and a plan and a process for doing it. We don't expect everybody to be able to do these things on their own. But, at least understanding it and knowing that it's an option. All right. So kind of the last little piece on the backdoor Roth and the conversion stuff is that there's forms that the IRS requires to be filed. And this gets messed up a lot especially on the backdoor Roth IRAs. If this is not done properly, that backdoor Roth IRA contribution does not count. Same thing with conversions. If we're recording these wrong, then we've potentially messed up the whole plan of action and created extra expenses for ourselves. So the 8606 form is the form that is used for any type of conversion, which includes the backdoor Roth IRA contribution, because that is a conversion. So if you're ever doing a conversion, we need to make sure that this is filed by your CPA and that the numbers are correct on there. Especially if we're doing the backdoor, we want to make sure that the math is right on how much is taxable and how much is not taxable. And then if we don't have these filed for the past, we want to amend those tax returns and get them in. So there is potentially extra work for CPAs if these were being done in the past and not done correctly or not filed at all, which they often are missed. There's also forms that come from the custodians like LPL, Fidelity, that can be a little confusing for CPAs if they haven't seen them before. So we just try and be kind of a facilitator and make sure that everybody knows what's going on, and then double checking the work. The other form, which is probably as important, not quite as important, but really important, is the 2210. We don't expect you to remember these numbers, but the 2210 is a form if we're doing a conversion, and we're doing it in one piece, which we typically do. So for us, we do it at the end of the year. So we kind of know where our client's income is going to hit. So October, we start looking at it so we can project it out. We're doing a one-time conversion. And the way the IRS is going to look at that is they're going to say, you have an extra $100,000 or whatever you converted in income. You should have been making estimated payments on that. You now owe us a penalty for not making estimated payments. The Form 2210 takes care of that, so that you don't have to worry about making those estimated payments. They know what you did. They know you did a conversion. You're good to go. We just saved you some fees. So really important forms. Make sure things are done correctly. Make sure we are actually getting the money into the tax-free bucket and that it counts. And then that we're not, since we're trying to minimize the tax bill anyway to the IRS, let's not also pay them penalties. All right. So in closing here, ultimately, it's probably not possible to create 100% tax-free retirement unless you're living below the Social Security threshold. In all reality, most of us are going to get taxed on Social Security at least. But the strategies that we've mentioned today can definitely create some positive flexibility in funding your retirement and anything that might pop up in retirement, which is really good for all of us and our clients. The key is really having a plan first, and then knowing that those plans are fluid as things change. And again, something is better than nothing, especially if you are growing your assets, investing in the markets, whatever. That's where the IRS is really going to benefit on all these strategies we mentioned today, is if we're not getting that money over, then growing the assets benefits the IRS directly. And then just kind of a quick note, if you are a client of ours, which I think most of you are on here, we are already working with you this year. We're going to be reviewing your returns and looking for opportunities to execute on any of these strategies we can. If you are not a client, we know these are complex strategies and they're difficult to execute. If you ever want to talk to us in more detail about your specific situation, call us. We can have a call and chat, no cost, no pressure. Happy to talk through any of that stuff. So I will kind of kick it over to.
Great. Thank you so much, Sadie and Cameron. That was very informational. Hope everyone found it as helpful as I did. Thank you again, everyone, for joining us. And please make sure to keep your eye out for our invitation for next quarter's webinar, Creating a Tax-Free Legacy for Your Heirs. As a reminder, we are recording this webinar today, and we will get it out to everyone as soon as it's approved by compliance. We do have a bit of time for some questions for Davey and Cameron. Our first question is, how do I know how much I should consider converting, and how do I figure out the taxes and everything?
You got it, Cameron?
Yeah, I'll take that one. I mean, it's going to be not a very satisfying response because the biggest thing is going to be that it's going to be entirely dependent on the situation. We've gone through a lot of these situations today in this webinar. As you can see, it comes down to a lot of things. The age of the clients, the amount of assets. I think the one that we would look at most would be the tax bracket that the client is in, and the state that they're in, because that's going to ultimately determine sort of when converting makes the most sense. But all of those things aside, we could at least look into, does it make sense to a backdoor Roth? Should they be contributing directly to a Roth IRA tax-free bucket? Unfortunately, it's sort of a one-off situational thing. But those would be the things we would ask on that initial at least call.
Great. And then our second question is, should I be contributing to my Roth and my 401k at work? How much is allowed and how much should I be doing? Zadie, if you'd like to answer that one.
Yeah, so some similar response here. Good question. Should you be contributing to your Roth 401k work? Again, it depends on how we're doing with, knocking down our taxable income with the pre-tax stuff. Before we start talking about Roth, we want to make sure that we're happy with where our current tax bill is for people that are still working. So don't have a really clear answer there. It kind of depends. Something is probably better than nothing, even if we just do a little bit. But remember, those contributions to our 401k at work are a way that we're lowering our current tax bill while we're working. So we kind of have to be careful there. How much are we allowed to do? I had to go back and forth with my CPA on this. So you're actually allowed to do the same as your normal contribution. So for 2024, you can do 23,000 if you're under 50, 30,000 if you're over 50. You could do that entire thing as Roth. The total amount is split however you do it. It's a combination of the pre-tax and Roth. So you're allowed to put in that total amount regardless of whether it's Roth or not Roth. So that's the cap. It's a pretty high number, and you're also not limited by your income. So even if you make over the $200 and whatever $1,000 as a married couple, you can do that max. You can still contribute to that. So good question.
Great. Thank you so much. So that's all we have time for today. I hope everybody has a great rest of their day, and we appreciate you for attending the webinar today. We look forward to seeing you soon. If we didn't get to your question, feel free to, like Zadie said, schedule a call with us, send us an email, and we will do our best to answer those one-off questions directly.